Okay, top of page 1, natural rate of unemployment. So we cannot reduce nations, our country's unemployment rate to absolute zero. So practical sense, natural rate of unemployment we mean. Practically, it means that we don't mean it. Practically, it means full employment. So, or putting it differently, lowest unemployment rate possible. Practically possible. So, from the full employment, we will full utilization of production potential. So, the GDP from at the natural level of unemployment we call natural rate of unemployment we call natural level of output. So natural means going which it's not exactly impossible. We can produce more than the natural rate, but it's not natural. You understand that, right? You can get A+ sitting up over the night. For these principles of economics, she can do that. Only one course she can do that, but she cannot keep doing that. So one course principles of business management or things like that. Understandable. So just one trial, you can produce more than your production capacity, but on a consistent basis, you cannot do that. If you try to do that, you will be overheated. Then you'll fall down. Likewise, economy will overheat, and then you will have inflation. Okay. So why can we not reduce the rate of unemployment to absolute zero? There are two reasons referred to in our textbook or in general, economics in general. Number one, frictional unemployment, and the other one, structural unemployment. Implication of the language, friction versus structural. Friction means it depending on your effort, you can reduce, if not full, but to a certain extent. Room for reduction, so by definition, right? So this is, or the surface rough is, friction is very high, right? If you reduce, make it more and more smooth, and then friction will be reduced. So depending on the efforts of the society, you can reduce frictional unemployment to a certain extent, if not altogether. So the implication of the term, frictional versus structural. Structural means you cannot reduce it by structure. Understandable? Okay, then life cycle, some of you are in introduction stage, while others are in growing strategy, while still others are in maturity. Who's in the maturity stage right now? TJ, are you in the maturity? Still growing? Declining? Okay. So of course it's a living thing. So as I say, product life cycle applies to all organisms. It's useful to remember organism. Almost by definition, okay, all organisms are subject to a product life cycle. That's the definition of actual organism. Then product is same time. Product life cycle is from marketing concept actually. Product is, if it is not an organism, product still is subject to life cycle. Individually, you cannot prevent yourself from declining. The living thing, so because the life is limited, so any living thing. Okay. Giant turtle, George lived 800 years, but not forever. Giant turtle, you see, from Galap died a year ago. Did you know that? There is, you understand, Galapagos, Ecuador, Galapagos, the island belongs to Ecuador. There was popular giant turtle named George, featured very from time to time in the National Geography. The particular turtle died a year ago. Anyway, it lived 800 years. But anyway, the life is limited. Okay, so you cannot prevent. But when it comes to other organizations, your business, okay, your business or the school or a country, a city is organism. So by innovating, you can prevent something from your organism from declining. So innovation is the keyword. So when you learn business or marketing or strategy, you will hear this story. To prevent your organization from declining, you have to keep innovating or bringing difficulty. Innovation is the only force which makes your sustainability possible. Okay. Of course, needless to say, a possibility doesn't guarantee the success. That's what you call necessary condition. Necessary condition, a necessary condition is not sufficient to make a thing happen, right? You understand the thing? So innovation is a necessary condition for sustainability of an organization, but not sufficient condition. Sangyeon, are you with me? Do you understand what I'm saying? TJ, are you with me? Okay. So keep going. So, last week, Wednesday, I explained traditional monetary indicators. But now, these days, at least in Korea, the names are slightly different. Okay, this book is the most authentic book related to indicators, as I say, economy indicators, most authentic because this book was published by Bank of Korea. So most authentic source as far as the macroeconomic statistics are concerned. So Bank of Korea updates this book, particular book, maybe every 5 to 5 years. Then the whole book is available in 교보문고 or other things like that. And the better news that is that chapters are freely available to you over the internet. You visit Bank of Korea homepage, so you can have free access to this whole book. So when you are not sure about the definition of a thing, in general or particularly in Korea, I refer you to this book. This book is free to you. So according to this book, the most recent definition of monetary indicators in Korea is this. Okay, let's briefly take a look at that. Top of page 2. So you see the bottom left, you see 현금 통화. Those of you who cannot read Korean language, that's very sorry. But anyway, your system is slightly different than Korean system. Alcharam, do you read Korean language, right? Okay, so you can understand me. Jisina, do you? Slightly? Slightly? No, you cannot understand Korean. Reading is okay. Conversation, speaking, how about you? Okay, so then you can understand what I'm saying at least. Okay, so this diagram, bottom leftmost column, you see 현금 통화. This is what we call currency in circulation. Okay, so the unit you have number 29 means 29 trillion won. It's clear. So that's the baseline on top which you keep amassing other things, right? So 요구불 예금, demand deposit. 근데 수시 입출금식 예금 is slightly different than 요구불 예금, but from all different types of like stock brokerage firm or we have something like not exactly commercial banks, but something whose function that the function of which is similar to commercial banking. So you can deposit and you can freely deposit, withdraw. There are many instruments now from all different types of organizations. You learn how many different types of financial organizations we do have in Korea. Your assignment, right? This is you. So I'll return this to you today. Anyway, you learned how many different organizations we have in Korea. So some of them, many of them work pretty much similar to commercial banking. Free deposit, free withdrawal. You can do that. Then SUSI, the name implies you can do that anytime you want. Then you can deposit, withdraw. So all those numbers are. So basically, that's equivalent to demand deposit. Demand deposit, you can withdraw on your demand. So that's demand deposit. On the spot of your demand, that's named demand deposit. On demand, you can withdraw it. Okay, understandable? Hunji, you are with me, right? Demand deposit, you can withdraw the money back to you on your demand. We call demand deposit. So, keep amazing. Now M1 is how much? 390 trillion won, not dollar. Number is there. You follow me. The number is here. CIC, the number 29 trillion won. Do you know where we are? Okay. So M1. Okay, M1 is of course CIC plus demand deposit. So equivalent to money. Demand deposit, you can withdraw it immediately. And then slightly, then on top of M1, we add up slightly less liquid deposits or other financial instrument. We call 금융수단 financial instrument. Deposits are only one type of all different types of financial instruments. So here, one more time, we add, okay, we add on slightly less liquid financial instruments on top of M1. Then you call M2. Okay, M2, how much do we have? So a little less than 1,600 trillion won. Okay, so once I said that, these days M2 is the most typical monetary indicator. So simply put, without any qualification, money, we mean M2. So over M2, how much is in the form of currency in circulation? What percentage? Less than 2%, right? Okay, so from this, we can conclude that only 2% of M2 you can put in your pocket. Okay, underneath your mattress, which TJ keeps doing. You put money underneath your mattress, right? Or you closet, or cuckoo clock, like Yujesuk does, right? Understandable? So where is the money? YG, where is the money? Yonggyong, where is the money? Dongyun, where is the money? Dongyun, where is the money? Hyunung, where is the money? 98% of the money is in the bank. So when something 90% true, we say it is true, right? Normally. So Kyunghwa is a good student. We mean okay, typically she is good, not always, right? So what percentage of your time, Kyunghwa, are you good student? 90%? I don't believe so. She is only 60%. So Hyunung is a good boy. That doesn't mean Hyunung is always good, right? If you are Hyunung, if you are okay, right 90% of the time, you say you are right, right? Do you understand what I'm saying? 이창, right? So when we say a thing is true 98% of the time, we may say it is true. That's what we say normally, the way the general practice, right? So 98% of the money is in the bank. So then we say, roughly saying, very closely, we can safely say money is in the bank. Okay? So small pocket change is in your pockets or purse or all the underneath mattress in the closet. Okay? So anyway, understandable. So we'll come back to this point in spring once again. It's, one of the key understandings in the monetary economics is money is in the bank, not in your pocket. So money rarely leaves its jurisdiction. Okay, Korean government controls Korea won. So Korea won stays in Korea. US dollar stays in US. European euro stays in Europe. Type of thing. Okay, monetary multiplier we understood. Then simply put, if money is deposit, right? In general, money is we define money deposit. So to make M deposit, how much M loan? How much money do we have to reserve? This is total loan, right? Equivalent to loan. How much money do we have to reserve? Right? We reserve with high powered money. Okay, so in a sense, is there? Okay, so okay, this is enough. So the other way around. Either way, so once we found out the H, this is the same story, right? We do complicated process, we find this out, right? This should hold. But the other way, very simply, if loan is, if we regard loan as the same as deposit, if M is total amount of loan, we have to reserve, right? That's reserve ratio definition, right? M multiplied R is this total amount we have to reserve. That's high powered money, right? So same story, it's back and forth. So either way, you can understand that. Okay, now leftovers from the last week. Shortage of time, you couldn't cover this. Bank run sometimes equal there. So if in the normal times, would you withdraw money from the bank? Would you withdraw money? On normal times, would you withdraw money from the bank? Okay, see, you would withdraw the money. TJ, 현민, normal times, which would you, in what form would you carry your money? In currencies or deposits? Deposits, right? Because I strongly recommended, I discouraged, right? I discouraged you carrying big money, right? So don't do that. Big money, let's say more than 1 billion won in cash. That's extremely dangerous. Okay? Don't do that. So normal times, you wouldn't withdraw money from the bank, right? Okay, so normal time, so from bank's perspective, so once we understood this one, okay, bank balance sheet always useful, right? Bank balance sheet, this side is deposit. Deposits are bank's liabilities. From a bank's perspective, okay, deposits are liabilities, right? This consists of two things, loans. This is actually what we found out from the exercise. In the beginning, there was a deposit from, who was the first depositor the other day? One of you was the first depositor, right? The other day. So loans plus reserves, right? Right? This is what we found out the other day. So who was the first depositor Wednesday? When we played, you were the first deposit, okay? So and then at that time, as I explained, deposit was something like this one, right? We ended up, this was how much? This was, okay, this is initial, first deposit. And they keep doing this. Then at the end of the day, this was 1,000. Okay, this was 9. Okay, there's a deposit how much? Right? This was, at that time, this was the equation. So it should be this, look like this one, because double entry bookkeeping principle, left hand total sum left hand side should be equal to total sum right hand side. Also, are you with me? Okay. So think about that. So from this one, you can very easily understand the case of bank run. And of course, this is, we assumed the R is 10%, but in the reality, it's much smaller than 10%, 4 or 5% in general. So it's like multiplication, amplification. This is 10%, the 10 times multiplication, right? If R is 5%, 20 times multiplication. R is 4, 25 times multiplication. R is 2, 50 times multiplication, right? Are you with me? Okay. Mingi, are you with me? You understand what I'm saying, right? Okay. So even in this case, okay, bank run is when the a bank loses confidence from its clients. So you see, if you so Sang-Yeon, what would you do if you see it's unsure whether you can withdraw money? The bank will be in safe position maybe a week from today. What will you do? You are unsure about the future of your bank. What will you do? You would try to withdraw the money, right? Okay. What will you do? Mingi, you do the same thing, right? So only deposit. This is reserve money is, so in this case this one, right? So he wants to withdraw the money because he is unsure about the future of the bank, because that's a natural action, right? You have to do that, okay? In a sense, you have to do that. If the bank is unstable financially, first thing you would like to do is withdraw the money from the bank, right? Because if bank goes bankrupt, so wouldn't be any way to recover your deposit or your loss from the bank, right? So let's say he wants to, his money is too big. Some of you, deposit, it kept decreasing. It keeps decreasing, right? So let's say, okay, so Jeho's is something like, Jeho's deposit is this much, okay, and the Mingi's deposit is 300, okay? Or Jungwan's deposit is 500, something like this, 500, like this. So all this type of things, right? So somehow, okay, Jehu has claims to have gotten special information, okay, only proprietary information. Proprietary means available only him. So he somehow he thinks, oh, the bank is unstable. What would be his first reaction? What would his first withdrawing money, right? Okay, he wants to. The key point is that only the total reserve amount is 100, right? 100. No, 1,000. You understand that, right? If Jehu only wants to withdraw money, there is no problem, right? There is no problem. Okay, but his neighbor, okay, Jehu's neighbor, something special with Jehu. What the hell is this guy is doing? So he keep asking, what's the secret you have? And then he has the same information, right? And then he wants to withdraw the money too. Okay, this is gone. This is gone. This is gone. Keep going. Then 1, 2, 3, up to here, okay, right? But any additional person wants to withdraw, bank doesn't have money. The only way to do that is recalling the loans. Okay, deposit is mostly on demand. This is not on demand. Deposit is not, loan is not on demand. Any loan agreement has its specific duration, due date. It's due. So in a year. Okay, so a bank, you don't have the right to call the loan in prematurely. You cannot do that because that by contract. Loan is on the basis of a contract. So contract means amount, interest rate, and then payment due is all fixed from the very beginning. So before maturity date, there is no way, no legally call the money in prematurely. So, but on this side, you have every obligation. Okay, the bank has each and every obligation to meet any client's request to the money back. Understandable? So only one or two, okay, no problem. So the key point is that normal times, nobody would like to withdraw big money out of the bank, right? If anyone does that, he is irrational or crazy. Understandable? So as long as the bank has a firm confidence from their clients, there's no risk of this type of bank run. Bank run means as one goes this direction, all the other follow that direction. So bank run, so as Jehu runs to the bank to do what? You withdraw money, everybody else follows Jehu. That's what we call bank run, 은행 쇄도. Understandable? So once bank run happens, the bank cannot manage the situation. The only way is belly up. Belly up is turning around. You see, when goldfish dies out of oxygen, belly up, right? That's English actually. Okay, colloquial English. Belly up means going bankrupt. Going bankrupt, you go belly up. You go belly up. Okay. So sometimes go broke, go under. That's colloquial English. Okay. A firm goes under, goes bankrupt. Goes broke, goes bankrupt, goes belly up. Same story. Understandable? So this is what you call. So from a bank's perspective, okay, not to lose confidence, okay, of the clients, the key. It's understandable. Okay, getting back to the page 3. On top, bank run with confidence of the public. Then there is no reason why new deposits in general new deposits from time to time people need to withdraw money, right? Because just whose case? Okay. For one reason or another, people need to withdraw money, right? So that's happening every day. But all in all, if that's one thing, right? On the left hand, people keep withdrawing money from the bank. On the right hand side, people keep depositing money as well, right? Do you follow what I'm saying? So normal times, which would be bigger? Okay, average deposit amount, daily deposit amount, okay, average daily withdrawal amount, which would be bigger? Deposit would be bigger. That's almost by definition because economy grows. Economy grows and gets bigger and bigger and bigger. So deposit this will be bigger than this one. So no problem at all. Even if the bank is not 100% shape, only 10% shape, right? 10% shape means is that the bank is prepared to pay the money out only 10% of the depositors, right? That's 10% shape. But normal times, 10% shape is enough to be shape. For the bank to be in shape position, right? Understandable? Okay. But something goes wrong. Okay. So bank run. So bank run is a chain reaction. That's big problem. Chain reaction is that banking business is highly interconnected. That's big problem. So once one bank goes belly up, all the other banks are in shaky situation as well. Understandable? Okay. Interrelationship is what I mean. What do you mean by that is Shinhan and Kookmin, they have multiple borrow and lending positions. So once Kookmin goes under, then Shinhan cannot have its money back from Kookmin. Then Shinhan doesn't recover its loans to Kookmin itself will be put in serious financial difficulty. Understandable. So that's a problem in the financial industry. So this is what. So because of this problem, you have heard of too big to fail. Too big to fail. You have heard of that, right? Too big to fail is that a bank is big bank. Okay, so once big bank. Okay, so Kookmin is big enough. Shinhan is big enough. Maybe small, let's say Gangwon Bank goes bankrupt, may not be so serious problem. The implication or impacts or effects on the rest of the economy will be very minor. Then the government would not intervene in the marketplace and save Gangwon Bank. But it will become totally different story if Kookmin is at the brink of bankruptcy. It is very serious trouble. So Kookmin goes bankrupt, Korean economy will go bankrupt as well. So Gangwon is very minor. So Gangwon is not too big to fail, but Kookmin is absolutely too big to fail. We call Korean language 대마불사. You know 대마불사. So this is it. Then, because this is a confidence game, here, when something goes wrong, this is self-fulfilling prophecy from animal spirits. Animal spirits is that everybody tends to follow everybody else without knowing where to go. That's we call animal spirits. Okay, it's a group reaction. So, when Jehu runs to the bank, everybody will follow him. Everybody else will follow him because there's something wrong. Okay, normally he is steady and guy, and then something. So unexpectedly he runs to the bank. Right, everybody will catch it. Something wrong with that bank, and then everybody will follow that. Only Jehu does that. That's okay. So only Jehu think. Okay. This bank's financial situation is shaky. No problem. But the thing is, by nature of human nature, that's by human nature. Human beings are not supposed to be animal, right? Are human beings supposed to have animal spirits? No, we are not, because we are human, right? But okay, unfortunately, we are not divine. Are we? Jingyang, are you divine? Are you human? Are you animal-like? Sumin, are you animal-like? But from time to time, everybody, including me, everybody shows animal-like reactions. This we call animal spirits from time to time. So once Jehu runs to the bank, then everybody else tends to follow Jehu. So if one goes here, why does he run to here? Because he thinks something unfortunate may happen. Okay, something unfortunate, something bad will happen to the bank, right? I say something bad will happen with the bank. That's his thinking. But only he rushes to the bank. Something bad doesn't happen, right? Because him alone, his effect on the bank is very minor. So him alone rushes to the bank. But the problem is that human beings are suffering from animal spirits, which we are not supposed to are. Okay? I know that someone reacts very much like an animal. Okay? I know that. So does Jiyeon too, Seungyeong, everybody, Giyoung too, Jargalan too. So reaction is no, it is Yeonil. Okay, you are Yeonil. Okay, very much too. Okay, understandable. So without knowing the reason, as Jehu runs to the bank, he runs to the bank, he runs to the bank, right? Then what? Something really bad really happens, right? That's what he call self-fulfilling prophecy. His prophecy was that the bank will go bankrupt. That was his prophecy, right? If that affects only him, it doesn't affect the whole system. But the problem is that human beings are suffering from undesirable syndrome is animal spirits. That's a syndrome. So because of the syndrome, undesirable syndrome, one person's prophecy, the bank will go bankrupt, will makes that happen. Prophecy happen. That's what I call self-fulfilling prophecy. 자기 실현적 예언. Understandable the situation. Okay, these are very popular concepts among economists. Animal spirits or self-fulfilling prophecy. These concepts will come back to time and again. This is nature. So at least partially to mitigate this type of thing, self-fulfilling prophecy, many governments have introduced deposit insurance. Don't worry. Something goes wrong. Goes wrong means even when the bank goes belly up, the government will come back to you and pay the deposit to you. That's the thing. So the thing is that has the effect not to make discourage or refrain, to make all the other depositors refrain from running to the bank, right? Because if you understand, so even if Jehu think the bank is shaky, he runs to that. But you don't need to do that because just in case, what government will pay you the money instead of the bank, right? So you don't need to run to the bank even if Jehu does that, right? Is that clear to you? So because of this, the problem is, as we saw here, the basic problem in general, the problem comes from animal spirits, right? If Jehu only runs to bank, there's no problem. Okay? The problem is group reaction is the problem, understandable. And then government guarantee, insurance is kind of government guaranteed. In general, the deposit insurance corporation is run by the government, at least partly run by the government. So that's kind of government guarantee. So if there is government guarantee, you don't need to rush to the bank, not whatever happens to you, no matter what. Understandable. So no animal spirits, no herd mentality, and no problem at all. That's kind of right. You understand the chain of logic thinking. Understandable. That's one thing. And second thing is this one. The Fed's implicit guarantee. Fed is the central bank. Here, generic name is central bank. Fed is of course America. As we understand, bank is implicit guarantee as lender of last resort. Is that really sometimes or just lip service is that the chairman of central bank keep telling, especially in crisis, the financial crisis, Fed chairman Alan Greenspan did that, and Ben Bernanke does that right now, and then keep telling to the public, just in case, we are here, we protect, we are ready to rescue failed commercial banks out, meaning we keep supplying endless liquidity to the bank. Then meaning is the reserve keeps increasing. As we understand, as central, you know that, right? Central bank balance sheet. Then this reserve, this was loan to the, we had, this is central bank, BOK, or you see that, loan to the bank, to the commercial banks, and reserve account, right? then this keep lending money to that. This keeps increasing. Reserve money keeps increasing. We do that endlessly. So however much it may take, we are ready to supply the liquidity to the understandable. So very often that's just lip service is enough, because you don't need, think about it, lip service, if there is a guarantee, you don't need to withdraw the money in the first place, right? Is that clear? So very often lip service is enough without really supplying additional reserve. So just lip service. I guarantee you. Okay? So if I guarantee Jung-ah whatever she does, so you don't need to require her money back to you, right? Because I am here. Understandable. So as long as the central bank firmly announces its intention to back commercial banks up, you don't need to withdraw the money, right? As I keep saying, withdraw money is extremely dangerous. Number one, you lose interest rate. There is no reason whatsoever to withdraw money from the bank in normal times. Understandable? Okay, then, so these cases, they are very, very bold. Especially Bernanke has been very assertive and bold actions from time to time. This one, very unusual thing. Probably you have heard of QE 1, 2, 3, quantitative easing. At this moment, you don't need to know what this is. Very, very extraordinary measures by the not normal thing, but there is such a thing is enough. It's enough to know that there is such a thing as quantitative easing, QE. And then what to directly to control? So remember, monetary policies. Time is up. First hour is already okay. So anyway, we have enough time. I can manage the speed. So manage time, don't worry. So the thing is that what is the ultimate goal of monetary policy? Price stability, right? Or plus a little bit of employment stability, the prime stability. So two things to do that. Money or interest. Yeah, highly closely related. We'll come to that today. Next week, we'll come back to this point. Next week, we have only 3 more weeks, right? Today, next week, this week, next, and then final exam. So, how closely these two are related is we'll come back to this one. But anyway, what directly to control for central bank? M or R? Okay. So, as for now, historically, like 2-3 decades ago, central banks most central banks tried to control interest rate, directly control. So that means indirectly control the money supply, interest rate. And then beginning of late 1970s, most central banks tried to control monetary indicator, money supply, M2. Now, maybe ever since 10 years ago, now most central banks focus on interest rate. This is only because these days it's extremely difficult to define monetary indicator, because there are all different sorts of payment process, right? You can just the internet banking or credit card, many different things. It's simply, technically, it's almost impossible to collect all the data and clearly define what monetary indicator is, simply because of this one. So, our conclusion for this is that now every central bank tries to control interest rate. Take Fed, for example, federal funds rates in the United States. When you hear news report these days, okay, as I said, FOMC, American for Federal Open Market Committee, FOMC, meets once every 6 weeks. Korea 금융통화위원회 meets every 4 weeks. And then the public pay keen attention to what decision specifically regarding interest rate has been made. So American case, whether to maintain or change the federal funds rate. Korea 콜 금리. Okay, so this is the sign that at least 2 banks of our largest interest is the Fed and the Bank of Korea. 2 banks now try to control interest rate rather than monetary indicator. So 1 down, another 2 go. We have to find out demand for money as always. It's slightly tricky to understand, but not impossible. So demand, no question. The supply of money at the discretion of Bank of Korea Central Bank or monetary authority. So demand for money is from the public, people like you and me. Now what defines demand for money? To understand this, so come to think of it, always the basic tool is supply and demand, right? So this is product market. Or factor market, same story, quantity, price. So once I said this in general convention, oh, there she comes, oh, she slips in. Okay. This sleeps in like a burglar. Okay, so this is type of quantity, right? I said this is type of value. Okay, one type of value. Y-axis represent type of quantity, some type of value. Keep this in mind. So here again, quantity. Okay. Here. So value of product is represented by P. Okay? P. Here is very confusing. Value of money is the reverse. 1 over P. Why that is? Okay, I'll explain, taking 2 examples. Example number 1. Okay, example 1, easy one. Okay, easy 2, we'll come back this shortly. 2 ways to understand this story. Why the value is the value of money, the inverse of the price level. Here P means price level. What is price level, 원정? What is price level? Price of what? 우석, what is price level? You don't remember? 지연. Okay. Study pretender. Huh? Okay. 지연, what is the price level? Okay. 민기, what is the price level? What is the definition of price level? 성현, 태전. Average, the level of average product, right? No. The average of all products, goods and services, or the price of a representative product, right? That's price level. So let's take a Big Mac. A Big Mac is the representative product. Okay? So we say that $1, 1 Big Mac, BG. BG means Big Mac. 1 Big Mac is equivalent to how many dollars? $3. Okay, $3. Okay. One BG equals to $3. Okay, so $1 is equal to what? How much? How much? How many Big Mac? How much Big Mac? A third, right? So Big Mac is the representative product. Okay, so in terms of representative product, Big Mac is a third. $1 is of course $1. It's not awkward. Okay, a third Big Mac. Big Mac. Okay. $1 is worth a third Big Mac. Is that clear? Okay, now you step into Korea. now you found the 1 Big Mac equals to 3750, 3750원. Okay. So one is how much valuable in terms of Big Mac? So is how much on Big Mac? Right? From this you can clearly understand that which currency is more valuable, $1 or 1 won? Yunna, which is more valuable? $1, 1 won. $1, how much more valuable? 1,250 times as valuable as, okay. What do you call that? 1250. That's exchange rate, right? That's what I call exchange rate. Okay. Exchange rate means relative value of two currencies. That's nothing other than exchange value, right? Is that clear? Okay, that's so here absolutely clear that US dollar is 1,250 times as valuable as one Korean won, right? That's clear to you, right? Yunna, right? So it's a clear even to Yunna. Not to mention 수민호와 성원호와 기영과 연일. Right? 다은, right? You understand with me? So my question is that okay, in Korea, to buy 2 Big Macs, how much money would you carry with you? To buy two pieces of Big Macs, how much money would you carry with you? Okay. 6,500 won, 6,500 won, right? To buy 2 America, how much money would you carry with you to buy 2 Big Macs? $6, right? So price level is high. Do you carry around more money or less money? More money, right? Or putting it differently, somehow US dollar, Big Mac prices goes up to $6. Okay, $6. When the price is Big Mac price is $3 to buy Big Mac, how much money do you carry around? $6, right? Big Mac price goes up $6. How much money do you carry around with to buy 6? Because you have to have 2 meals at school, right? Lunch and dinner. So how much money would you carry with you? $12, right? So as price goes up, money goes down, right? The value of money goes down. You need more. As the value of money goes down, you need more money or less money? More money. Okay? That's 1A. So from that alone, you can understand this one. It looks like money demand. So this way is, okay, as you understand, okay, goes this way, okay, money, the value, this way, meaning this way. This is price level. As price level goes up, you need more money. Okay, so here price level is this graph is to tell you price level is okay the inverse of the value of money. Okay, so here initially we start with price is 1. Okay, price falls to 2. So price initially the price was 1. Price level was 1. Okay, price now increases to 2. Okay? The value of money increases, decreases, right? Price as price doubles, value of money is cut in half. Okay? So price, so value, this was so this direction, right? Let's say price level, price index was 100, 200. Price doubles, right? Price doubles, the value of money goes up or goes down? Goes down, right? Value of money goes down. Do you need more money or less money? More money. So this one, this is here. You see, quantity M is this is 0, this is increasing this direction, money decreasing. So shapes in this way. Understandable. It's confusing because PN is the reverse way. But the basic approach is that we don't need this one. From this, you clearly understand. As price, remember, $3, $6. Value of money drops, cut in half, right? We need, let's say, use $6. Previously, we need $6. Now, cut in half, $12, like this one, okay? Understandable. So, 1 over P. P is, of course, price level. Price level is, once again, the price of representative product. Okay, representing both economies, Korea or America. So big man. So from this you can understand, as price level goes up, do we need more money or less money? More money. So more money is there. So why do we have this one? Okay, to follow the general convention. This direction is price value goes up, right? This direction. Here the money, this direction is value goes up. Is that clear? So just to follow, to match the general convention of this one. Quantity versus value, two-dimensional axis. This direction, quantity goes up, right? This direction, value goes up, goes down. Goes up. So only this way you can match you can follow, you can apply the general convention of this one. Understandable? So key point is that as price goes up, okay, money goes down. That's key point here. Simply put, okay, demand for money is this. Okay, M. Okay, M, of course, demand for money. This is 1 over price level P. Understandable. So another example is, this is actually my favorite example. You follow me here. Question here. Assume that you consume 2 bus rides, okay, 1 lunch, okay, 1 coffee, and 1 bribe to the professor me every day. You have to give me one bribe to me every day. So nobody does it, right? You don't need to do that. So if the prices are 1, 500, 200, okay, so 100 respectively, how much money do we have to carry? That you have demand for money. How much money? How much do you need? 2 bus rides, so 200, right? 1 lunch, 500. 1 coffee, okay, so 900. So 1,000, right? You need 1,000. You have to carry 1,000. That's your demand for money. Demand for money. Is that clear? What if price doubles? 200, 1,000, 4,000, 400, 2,000, 200. How much money do you need to carry? 2,000. Right? Understandable, right? As price doubles, you need twice as much money as otherwise. Right? Is it clear? So, price level goes up. Do you need more money or less money? More money, because the value of money declines. Okay? Price of. So, money of this case, okay, value of declines, do you need more or less D? This typical demand curve. Value declines, do you need more or less? Your demand increases, decreases. Value decreases, price decreases, demand increases, decreases. Increases. Okay, so likewise, as value of money goes down, do you need more money or less money? More money. Same story. Eh? Now it's understandable. Okay, it's tricky but quite understandable. Then law of demand and supply. Supply is always, that's always our end point is, okay, to make a clap, right? We need 2 palms to make clap, to clap. So one is demand palm, supply palm. Okay, we have conclusion. So this is it. So money is, okay, fixed by, we call at the discretion of, that's a policy variable. Policy variable means it doesn't have anything to do with the value system or anything. So simply the government fixes, oh, this is today's money supply. Money supply. Okay. Then sometimes government squeezes. Okay? Reduces money supply, other times expense. Okay? Expansion or contraction, that's normal, typical, standard language. Contraction, expansion, monetary expansion, monetary contraction. Okay? Then meaning monetary expansion moving this way, that way. Expansion, this way, that way. That way. This is monetary expansion, MS. This is 0, MS 1, 0. This is contraction, MS 2. So beginning MS 0. So moving to MS1 equal monetary expansion, expand. Okay? And the other way, monetary contraction, contracts. Okay. Then what happens? Money contracts. So here, originally we had, how much money did we have? M0. Okay, this is equilibrium, and then this price equilibrium, 1 over P0. Okay, so now my question is that what if government, okay, government expends its money here? So government money is MS1, right? Government dumps, okay, money upon us, the public. So all of a sudden you find out you have more money than previously. So in a sense you have extra money, right? So Sumin, what would you with the extra money? The government simply dump upon you more money. Previously in this table, let's say we have only here the population is let's say 30 population, total population 30. So previously you had only, okay, 30,000 money. It's money. We played with 30,000 money. So how much money in average do you have? 30,000. 1,000, right? 1,000. Each of you have in average. Is that clear to you? So population is 30. Right? So total money available to all of you is 30,000 won. So in average, how much money do you have? 1,000, right? So now government dumps money, increase its supply to 60, okay, 60,000. Then previously, how much money did you have? Now how much? 60,000 total. 30 people, 20,000, right? So now all of a sudden you find out. Okay, so I mean you find out. Yesterday you had only 1,000 won, right? Today you have 2,000 won, right? Then it's kind of extra money, right? So what would you do with the extra money? Would you burn it? Jian may burn it, okay? Because she's catching a slightly cold. So to warm herself, she may burn the extra money, right? Oh, would you eat it? Someone is hungry. Would you eat the extra money? Hyunmin may be to give extra money to me because she doesn't. So what would you do with the extra money? Do you understand? Follow me the story over there. So originally, the MS was same number of people here. Originally, same number of people. Money supply was something like 30,000 won. Double it. But in average, each of you would have double as much money as before, right? So in a sense, you have extra money. The thing is that normally, if the price is case number 1, okay, so your lifestyle, every day you consume 2 bowls rice, so that's assuming your lifestyle is the same as before, everybody is the same as before. Now all of a sudden, at the previous price, you need only 1,000 won, right, according to this. But as government doubles, okay, dumps upon you, 2,000, you have all of a sudden you have 2,000 won each, right? So for your everyday life, total money you need is how much? 1,000 won, right? So in a sense, you have extra 1,000 won. You somehow you have become to have extra money 1,000, right? With the extra money, what would you do? Burn it? Eat it. Give it to me. Extra money is only one option is, okay, spend it. Spend it, right? You don't have extra money, you buy it, something else. Spend it because everyday life you need only 1,000 won, right, in your pocket. To keep everyday life learning, you need 1,000 won. But somehow you have more money than you need. Then probably you will spend it, right? Okay, you will spend it. So Kyunghwa wants to buy extra cafe bene, extra cafe bene, extra cafe bene, extra cafe bene. What happens to the price of cafe bene? Goes up. This is it. So price goes up. So here, move this direction. Government dumps upon you more money. Nobody would burn the money or eat the money or give it to somebody else, right? Giving it to somebody else, it doesn't solve the problem because, see, individually you can reduce your money holding, right? Giving it collectively, you cannot do that. So, for example, so this is a 4-person economy. Okay, I give originally 1,000, 1,000, 1,000, 1,000. I dump my money double. Then she would like to keep the money to Kyunghwa. The money moves here, right? But total number is always 4,000. You cannot change the number. Okay, that's what I call the type of fallacy of composition. Individually, you can reduce money holding. Individually, you can reduce money holding. You can never do that unless you eat or burn it, tear it, bury it. Is there anyone who wants to eat or bury, burn the money? You cannot. Nobody would do that, right? Understandable. So as long as nobody do that, okay, nobody does that, there is no way to reduce total sum of the money available to the economy. Understandable? So that's what I call it. The type of fallacy of composition is that what is individually true may not be true collectively. Okay? What is true individually may not be true collectively. So what is good for Yunna is good for this class? No, I don't think so. Because it's grading quota is limited. So I give A plus Yunna. I cannot give A plus to Sumin. Okay. Understandable? So, okay. What is good for one is in general good for the core. Huh? What is good for microeconomically is in general good for macroeconomically too, but not necessarily. Understandable? So here, previously M, we have more money, right? What is the consequence? I dump upon you with more money. I dump more money on you. What follows? Price goes up, right? Only also price goes up because extra money, everybody will try to spend the money. As money, more and more money wants to spend more money, price goes up. This is it. So here, this is MD curve, right? Expands here this direction. This is move this direction, right? Value of money falls down means what? Value of money falls down means price level goes up, goes down, goes up. Understandable. So from this you can very easily understand this one. So everything else being equal as always, everything else being equal is GDP is the same. Okay, GDP is the same. Quantity of production over a year is the same, but simply dump twice as much money, all prices will double. That's easy to understand. Okay, now more theoretically, this is more or less intuitive approach. Yeah, more theoretically, this one. So, okay, so let's, the bottom of page 4 is that law of demand and supply, money market equilibrium, figure 2. This is it. This is it. So, as MS is somehow bigger than MD, meaning the government dumps more money on you than yesterday. Then all of a sudden, remember, GDP hasn't changed at all, and your lifestyle hasn't changed at all. So everything else being equal, then you need more money, and then everybody would like to spend more money. Price will go up. Then that's only equilibrium is here. Okay, intuitive approach. Now more it's how can I say that in terms of verbal terms, this is graphical illustration as opposed to verbal explanation. Is there? Then this one. So two types of economics: classical economics and Keynesian economics. As you understand, Keynesian economics came into being for the first time 1936. Okay, what is special around this time? In the aftermath of Great Depression. Okay, so still the global economy is, of course, this one. Global economy was suffering from recession, not recession, depression. Depression is a serious recession we call depression. Then, so in the aftermath of, so nobody had a clue what to do, what for the government to do. Nobody had a clue, but he came up with a new prescription. Is demand side economics, Keynesian economics. We'll come to that in chapter 33 or chapter 4. And before that, classical economists used to classify the whole economy into two independent groups, chapters of. The one is real economy and the other is monetary economy. And then this one, what that means is that key point is this one: money does not change the real variables. Real variables is all about y, c plus I plus g. Right? That's real variable. Y, real GDP, c, consumption, all real variables in this way. Then x minus m. And these are all variables, real variables. The thing is that why two independent sections of the economy is that money doesn't affect this one. Whatever, how much money, only all that is just you did. So I dump twice as much money, because price level goes twice as high, right? I give you money. Then only effect of monetary increase in change in the price level. Change in price level. So as you understand, there is no real difference, right? Remember, each day you need 2 bus rides, 1 lunch, 1 coffee, 1 bribe. It doesn't affect you, right? Dump twice as much, it doesn't affect you. So money is, the only function of money is the price level doubles. I dump too much, twice as much money, price level, every price doubles. That's the only effect, right? But your consumption is not affected by you. So I keep saying, right, the case. Whatever the money supply is that you need 2 bus rides each day. Whatever the money supply is, you need 2, that's a real economy, 2 bus rides, that's a service, right? Your consumption of, transportation service is bus rides. 1 meal, that's a service, utility. And then what else? Coffee, there's something else, right? Understandable. So that's a classical viewpoint. Money is one, real economy the other. You can completely separate one from the other. Monetary economy, and so money is simply nothing other than what you call veil theory. Sometimes you call veil theory. But it doesn't affect real thing. So because of this, classical economists, you discuss real economy first. That's chapter 25 and 28. Now monetary economy, chapter 29, 30. Two systems are completely separated, one thing and the other. Understandable. That's what you call classical dichotomy. Good boys, bad boys. Dichotomy, right? Nothing in the middle. So here, this is good boys, bad boys. Mingi is somewhere in the middle? No, you don't. You don't suppose anything like that. This table, ultra long, and this side, good students, bad students. ultra long is in the middle? No, we don't presuppose anybody in the middle. That's what we call dichotomy. Divide everything into two categories, dichotomy. So this is real economy and this is monetary economy. They don't have any association between two of them. Okay, that's classical dichotomy. Now Keynes comes up, money to give some flavor of Keynesian economics. Money increases, will come to there eventually. Money increases, interest rate goes down. Okay, interest rate goes down. Okay, I goes up or goes down? Goes up. C goes up. Y goes up. So these are all real variables. Okay, that's Keynesian economics. Okay, both are right. Both are right means a long-term perspective, classical economics. Okay, short-term perspective, Keynesian economics. Both are right. The only difference in time horizon. You see, Keynesian economists are very short-sighted, less than 2 years. Okay, classical economists, long-sighted, longer than 2 years. Understandable? Okay, now let's continue discussion of this. This is classical economics. Classical economics we are discussing because we are today's chapter is 29, something like that, 29 or 30. Okay, understandable. So here, short term means less than 2 years. Okay, that's the Mankiew's definition. So it's handy to remember that. When you say short term means less than 2 years. Okay. So simply put, less than 2 years. If you think about what would happen in your economics, less than 2 years, that's Keynesian economics, right? You see, longer than that, that's classical economics. So if we discuss growth, is it classical or Keynesian? Growth. That's classical. Okay. Growth economics is classical economics, and the natural level of output, that's classical. Classical. Meaning is that in the long run, the economics will return to the natural level of output. This long run, the very long run, economy grows. Y itself grows. So it said that Y star is that natural level of output. Okay, so longer than 2 years, you leave the economy alone. Less than 3 years, economy will return to the natural level of output. That's typical classical economics. And the growth economics is how to enlarge this one. Right? Understandable. So these two things are growth economics. No, classical economics. Okay, now today's most critical understanding is this. Okay. Number 4, one more time. The summary of the key lesson from item number 4 is the monetary neutrality. Neutrality means money is neutral to the real economy, or the real economy means real quantity of production, real quantity of consumption, real quantity of investment. They are not associated with each other. It's one thing and the other. So only effect of money is defining the price level. Okay, price level, all, okay, simple question is that what if all prices double? Your income double, just okay, all prices double. Does it affect your life? It doesn't. Okay, so that's what this means. Now, the key theory behind this is what we call quantity theory of money. David Hume was okay. So actually, in the past, long time ago, all people were multitaskers, multitask doers. David Hume was a philosopher, economist, everything, politician, everything. So David Hume was this one. The velocity of money, number of times the average money changes hands in a year. That's the velocity of money. Okay, now M multiplied by V equals to this accounting identity. Accounting identity should be equal. So this is merely an identity, no theory. So Py MV. Okay, why this should be equal? Okay. By the way, how we define V, okay, in this way, or accounting, same story, accounting identity. Accounting identity means these two sides should be identical no matter when, no matter how, no matter what. Okay, either is okay. I simply give you. Okay, follow me. Many students don't understand. Simply memorize this. Okay. I think many teachers say simply, if you don't understand, memorize this. That's not the right way. That's not difficult to understand why this is so. So you follow me. Okay. On my experience, not this school, some other schools, my experience, many students didn't understand why this is so. Simply they memorize. This is what you call quantitative equation. And now I try to explain this to you. Then you can understand this, why this is so. Let's keep on. You follow me. This is very small economy. Okay, very small economy. So Big Macs, 100 Big Macs are produced in a year. Okay? 100 Big Macs. Produced means consumed in a year. This is a small economy. Okay? Each price, this is Y. Y is how much we are in very small Big Mac economy. Big Mac is everything. Okay? One product, millions of product, principally exactly the same story. So we assume Y equal 100 Big Mac. Okay, 100 Big Mac. Because we have only one product, we can now, Y is number of quantity of Big Mac, right? Y is 100. So at $3. Okay. So $3 for 100 Big Macs. What is the revenue in a year? PY, how much is it? 300. Okay. So this is dollars. Okay. Annual revenue. Okay. Now, what do you play this game with? Trade game with? Barter trade or money? Money, right? You play the trade game with money, because now almost nobody engage in barter trade, right? Almost this, because we live in money type. So money is cheap. Actually, money is cheap. You can play with. Play here means trade for another. So total chip of money is $51 chips. 50 chips. Each chips represent $1. So money, how much is the money supply? $50, right? $50 is available to the economy. So with $50, how many revenue did you create? $300, right? Understandable. So think about that. So each time a trade, money changes hand once, right? I buy something, one Big Mac from you. So this particular dollar changes hands from me to Yerin, right? Just once, okay. So a dollar changes hands from my hand to his hand. Changes, we call changes hands, right? Okay. There is only $51 bills available in this economy. $50, the outcome is that how much revenue do we make? 300, right? 300 with $50, right? So 300. What does 300 mean? Buying and selling, right? Buying and selling. So one selling, I have to need $3, right? $3 change once, right? Okay. Then to make 3,000. So I buy 2 Big Mac from Marines. Okay. So how much did I pay? $6, right? But once I had only $3 bills, right? Then $3 change twice. Is it clear? So from this one, you can easily understand. total revenue is $300. Okay. Then you had only 50 chips. So how many tons does each and every dollar make? 6 times, right? Is that clear? There could be no other answer. $50, that's the definition of B. This is 6. So I'll give you half a minute to understand this, digest this story to you. It doesn't matter, okay? It doesn't matter. Whatever definition is there. Okay. If M1 is 50, M2 is 50, so whatever you take as your prime, your prime indicator of money. Okay? You simply talk of this as currency. Okay? Currency in circulation. Story is the exactly same story. It doesn't matter M1, M2. Simply this is money. To understand this principle, okay? Forget everything else. Just focus on my story here. Okay. So 100 Big Mac, $3 each. So what is total revenue? 300, right? To make 300 revenue means $300 payments, right? $300 payments in total. Who buy from whom? It doesn't matter actually collectively. So collectively, $300 payment has been made, right? With how much money? 50. The total number of chip is 50. Then each dollar has to turn over 6 times, right? 6 times. Understand, Higon? Do you understand this? 우석, you too. Jian, you understand? Hunji, are you with me? Are you sure? Jian, are you sure? You pretend to be sure. You are sure? You understand, right? She's annoyed by my question. Why ask me when this is so clear to me? That's a down attitude. Okay. Understand? Okay. So now MB equal PY. This is no additional information to it because this is identity anyway. This should hold anytime. A matter of definition. Okay. Definition means this is the way how V is defined. V is defined. Okay, now theory. This is theory. As I say, the starting point is, as we say, quantity theory of money. This is a theory. Is that this one? This is most typical classical theory. M is K P Y. Okay, P Y. This is the case. Why P Y? You need how much money each day? 1,001, right? You need 1,001. Okay. So your demand for money. So 1. Okay. This is what this is. This demand money. Your demand for money is fixed fraction of total sum of your trade volume. Okay. This. So this is a theory. One more time. This is identity. This is another theory. Identity. And this is the. This one is the M equal K. K P Y. Is money demand. This is a theory. Your demand for money is defined as a fraction of P multiplied Y. The theory. Here, K is constant is the essence of this theory. Constant, so your demand for money is defined by constant is theory, constant fraction of revenue, P multiplied Y. Okay, K is constant is the theory. the observing the real world. Okay, classical economists came up with the conclusion that in the real world, K is pretty much constant. Okay. Why that is? It's a matter of lifestyle. Okay, does your lifestyle change every day? Pretty much stable, right? Your lifestyle is pretty much stable. So people's habits and cultures changes very, very slowly. So over, let's say, 5 years of time, you may assume K to be constant. That's a theory. So comparing these two things, this is equivalent to this one. K is 1 over V. Comparing these two, this is a theory. This is an identity. Comparing these two, K is, okay, why this? This is the way how theory is explained, okay. Well, this is the way how classical quantitative theory of money is stated. Okay? The way of expression is the way. Comparing these two, K is equivalent to 1 over V. So from this one, same story, right? Constant fraction of the assumption is the theory, the finding, not the assumption. So finding, if K is constant, what does it mean? V is constant, right? Remember, K is constant is the theory. K is constant is the theory, quantity theory of money is all about. One more time. What is quantity theory of money? K is constant. That's quantity theory of money. If K is constant, from this identity, you can easily find out V is constant too. Right? The same story. K is constant the same as V is constant. So either way, you can. Okay. This K is constant according to classical economics. Or you can say same story. V is constant according to classical economic theory. Understandable? Right? It's somewhat tricky, but okay. Anyway, you should be very clear regarding that. One is identity, the other theory. Okay. So one more time, quantity equation is an identity. No matter what, that should hold. Okay. Quantity theory of money is according to classical economists. Okay. V tends to stay pretty much constant. So here you see down near the bottom of page 5, the theory conclusion. The velocity of money is stable. Then M is this one. Okay. Then if Y is fixed, what happens? M goes up, what happens? P goes up. Right? Right? Okay. Or P goes up, money goes up. Or no, the other way around. Okay. Remember, what this equation means is this one. Money supply should be equal to what? Money S, let's say. Money demand, right? This is defined by what? This definition, okay? What is this? K P Y. Okay? This is K P Y. That's actually why I explained the first out today. So what if government doubles MS? What will happen to this economy? You have extra money, right? You do extra money. Will you give it to me? Burn it? Eat it? Spend it? So you spend it. You spend it. You spend it. You spend it. What happens? P goes up. So it is. So in a sense, this is identity here. So here, next time on, I should write is here. This is the following page, maybe. Okay, so I want you to add one more additional equation down below of this page 5. This why this is so M goes up, P goes up. Why this is so? Always, right? MS equal to MD equal. This is defined by what? Classical economics. This is PY. So I want you to add one more additional equation at the very bottom of this page. Next time on, I think I'll insert this equation here. This is Y. So my answer to your why question. Why question means that why M goes up, P should go up. This is the story. This is the answer. So in any case, MS should be equal MD unless you are not going to destroy any extra money. So you wouldn't do that. Nobody in the right mind would do that, right? Crazy people may do that. Are you crazy? No. So any question? The following page is, keep this in mind, expression in mind, very, very, very famous saying by Milton Friedman. Okay, inflation is always and everywhere a monetary phenomenon. So we'll learn more about this macroeconomics, but as for now, so what this means is that money goes up, P goes up. So P go up, you need monetary expansion, right? Because of this. Inflation is the price goes up, inflation. So to have prices go up, we need more money. So that's why Milton Friedman said, one more time, very, very well-known statement made by Milton Friedman. So inflation is always everywhere a monetary phenomenon. When you have inflation, always blame the monetary economist. Understandable? Okay, so this is it for today. Have a great week. You have still many days to go. Okay.